Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. Motilal Oswal came out with a note, I think yesterday or day before, wherein they've spoken about their views on the corrective phase that we are in, what it does to valuations broadly, and a set of investable thoughts in the corrective phase. I thought it would be great to get in the author of the note to talk about the note, yes, but also talk about what has he made of the commentary at the end of Q3 from India Inc. How have the implications of some of those high frequency indicators changed because of the commodity price upticks that we've seen for Q4? And what does all of this do to the earnings revisions? Sadly, on the way down for FY22 and FY23 as well, presumably for FY22 and FY23 most certainly. So Gautam Duggad joins in to talk about all that. Gautam, good having you. Thanks for joining in. Hope all is safe.
All good. Good morning, Niraj. Good to be here.
No, pleasure having you. Gautam, can I actually start off with that piece and then we move on to the broader note that you've written as well? I presume a lot has changed from the time Q3 ended. The companies gave their views on what they thought of Q3 and what could happen in Q4 and what might actually happen in Q4 because of the commodity price inflation.
Yeah, Niraj, so as you rightly pointed out, a lot has already changed in the last 45 days since the third quarter ended and 15 days since the earnings season ended. See, amidst all this crisis about Russia, Ukraine, from India's point of view, the most important thing is crude oil price. You know, we were at 80-85 couple of months back when the last fuel price revision happened. Since then, we have moved up around $35 to $40, right? As it is during the third quarter, the most predominant commentary from corporates across the board was on input cost. And it was also reflected in numbers. If you look at the gross margins and EBITDA margins of companies across sectors, almost every sector has reported a 200 to 600 basis point of gross margin contraction. However, despite all those challenges on margin fronts, you would have seen that at an aggregate level, both Nifty as well as our broader coverage universe of 220 stocks under Motilal Oswal coverage, they've reported inline earnings. You know, Motilal Oswal universe is posted at 22% growth, Nifty posted at 25% earnings growth. However, this was a very skewed performance actually. You know, if you keep aside financials, metals and oil and gas, these three sectors accounted for more than 100% of the incremental earnings. So if you remove these three sectors, there was no growth. It was a flattish performance, which still was in line. But that basically tells you the magnitude of this skew which was there in the earnings. And more importantly, after 2-3 quarters, we have seen number of downgrades outweighing the number of upgrades by a ratio of 1.5. So while at the aggregate level, again, for Nifty earnings, there was no change. It was very stable at 735 rupees. And in fact, there was a marginal upgrade for 23 and 24. But if you look beside the Nifty, which is our broader universe and even broader markets, you will see that there were a lot of earnings downgrades because of input cost inflation. So the aggregates gave you a very different picture. If you peel the surface, you will find that the picture was not as rosy. And the reason for that is the way index is composition. You know, even today, if you look at Nifty and you were touching upon how the forward revisions could be. You know, if you look at Nifty, more than 50% of the index is well insulated from commodity prices. In fact, financials and IT has no impact, and metals and oil and gas benefits from the higher commodity prices. 1/3 to 30% of the index actually gets impacted, which is consumer durables, auto, cement, to an extent telecom and pharma. So we had done this exercise, I think, a couple of months back when crude at first crossed 75 or 80. And we had reached a conclusion that index actually sees a marginal uptick on earnings because of the higher crude oil prices and commodity prices. The real problem is outside of the Nifty once again, where, you know, the pricing power is low, the input cost impact is much higher. So something similar can pan out this time. In fact, this morning we've released a note on cement sector. This is the first downgrade actually because of the input cost. Now we've cut our earnings estimate by about 18% for cement for FY23. and roughly 10 to 12% for FY24 because the coal prices have shot up, petcoke prices have shot up, crude oil prices, of course, and with a lag, you will also see it reflecting in freight prices and logistics prices. So clearly, and market obviously is not that right to absorb the price increases, which we have seen in cement sector. So EBITDA per ton, which used to be 1,500, 1,400 per ton till about 2 quarters back, has already come down to 1,000 and will go down further in 4Q and 1Q as well. You might see some more downgrades, but equally it will get balanced by what is happening in metals. You might see an upgrade there. If you know, by the way, for example, in FY22 as a full year, metals is going to be the single largest contributor to earnings growth. We are forecasting 36% growth in Nifty earnings for this year. And the largest contributor is metal, which is contributing 35% of the incremental earnings. And by the way, this sector has just about 3.5% weight. And we were expecting that in FY23, metal prices may not sustain, and therefore there was a expectation of a 20% degrowth. But I now feel that given the way prices are, especially aluminum and all, you might see an upgrade in metals. So we will have to see how this, things pan out once the dust settles. Where does this prices stabilize, and then how the companies react? So it's an interesting situation, honestly, just that there is too much of a flux.
Yeah, there is a fair degree of fluctuation. Gautam, may I ask here, actually, I'll come to the positives in a bit. So let's talk about energy and metals a bit later on in the show. Let me first talk about pockets that potentially could get impacted negatively, and where we've already seen some bit of a pullback, right? The market itself has come off, so everything has come off per se. But in the sense that in Q3, for example, when we saw the pricing pressures on paints, in the case of specialty chemical companies, wherein we saw severe margin erosion, the hope was that in Q4 some of them might be able to pass on the cost. But then came the whammy of higher crude prices as well. So in the pockets that get severely impacted because of crude and crude derivatives, what's your sense? Has the market started to price some of that already in? Or do you reckon there could be nasty negative surprises when Q4 numbers come out? Because the themes were already getting impacted even when crude was not at 110.
Absolutely, Niraj. So some of this is already happening. You are seeing price adjustment very clearly in specialty chemicals. So we initiated coverage on specialty chemicals in June 2021. And from June to October, the prices were up, stock prices were up 30-40%. And it is not as if those prices were cheap or valuations were cheap in June 21. From those inflated valuations, the valuations became even more insane. And then when you saw numbers for October quarter, September quarter, and now for the December quarter, where margins have collapsed by about 600 to 700 basis points at the gross margin levels, and now in the Jan to March quarter, you will see further decline. Some of the prices have started getting adjusted to the underlying realities and fundamentals now. So I think depending on the stock in the specialty chemicals basket, they are down anywhere between 25 to 35%. But they're still expensive. Given the kind of pricing power they command, I would think that they're still very expensive, and the price value equation still needs to get adjusted. They obviously have a very favorable macro element working for them, China plus one, and a lot of capex which is happening by the companies, new launches, etc. But the prices had run way far ahead of fundamentals. At peak margins, the multiples were also trading at peak. So now margins have corrected, but multiples are still very expensive, I would think. So that still needs to correct a bit. Secondly, paints, there is a subtle difference.
Can I just peel it one by one? Sorry, sure. I know I asked you the question about paints, but let me just peel it one by one. Gautam, so I read a recent note from you wherein from an earlier stance that you may have had because of different variables, and you were positive on some companies like Deepak Nitrite and Vinati and some of the others. I think you've scaled it down to only 2 or 3 companies that you're comfortable with. Why is that the case? And why have you left out some of the earlier ones on which you guys had a positive stance just 6 months ago?
Yeah, so see, we had a positive stance, for example, on Deepak Nitrite when we initiated. The price was 1,800. The price went up to 2,900 in 3 months. So valuations clearly were defying the rationality, given the way underlying earnings and cash flows were positioned and the emerging risk of raw material, headwinds. So we thought from that price, it didn't make any sense from a 1 year perspective to advise people to buy. So we, downgraded our rating. And as you rightly said, today we have hardly 2 or 3 preferred ideas in that basket. And that is also because, for any investor, it is not compulsion to own a stock in any sector, right? But when you ask my analyst, any given sector, specific sector for any idea, he will obviously give you a relative idea. So Nosil, Vinati Organics, and Galaxy Surfactants are the 3 names which we like. Let me give another example. Clean Science, we initiated coverage in August 2021, last day of August at 1400 rupees. The IPO had come at 900, and within 3 months, the stock had already rallied a lot. And when we initiated coverage at 1400 at buy, within 2 months, I think that stock went up to 2200, 2300. So we felt again our target prices for 2 year, 3 year got delivered in 3 months. And incremental risk reward equation did not look favorable to us. So we downgraded that stock. The stock went up 20% further from 2300 to 2700. But you couldn't justify it on valuation. Obviously, the company is great. The product they have amazing niche in the categories in which they're present, and the growth outlook is extremely strong. Just that the valuations had run up too much. I don't know where the price is today, but in some of these cases, the relative risk reward equation became completely unfavorable. So we downgraded some of those ratings.
But you're still not comfortable buying into some of those like Clean Science as yet. You will review it post the earnings, is it?
Yeah. So, I think the way situation is emerging, there is no rush to go and buy it today.
That's
right?
true.
While the prices have corrected 20, 30%, but given the way raw material prices have rallied, the earnings damage is also going to come in after 3 months or 6 months. So some of these earnings may get downgraded. From a fundamental point of view, I think the risk reward is still not favorable. Obviously, if the markets were to bounce back, some of these names will also bounce back. But if you're looking 1 year, 3 year ahead, I think compounding will suffer from this price and this valuation as well. So maybe you can go wrong and you may not get the price you desire, but this price value equation is not attractive in our view.
Okay, lest it sound like a spec cam conversation, it is not. Paints, that was the other example that we were going to talk about.
Yeah, so paints, Niraj, there is a slight difference. If you look at the history of the paint sector for last 25 years, it's a very nice oligopoly, right? There are 4 companies and now there is a 5th one, Indigo Paints. And Asian Paint is the leader right at the top with 60-65% market share. The companies have pricing power and they exercise it. You will always have some difference or lag in terms of when the raw material prices hits you and when you exercise that pricing power. For example, till December end, you would have seen that companies had already taken a 20% price hikes in the decorative paint segment. And that 20% price hike was sufficient till $90 crude. Right now, obviously, they will have to reassess the situation once again. But look at it. The volume growth has not suffered in paint despite 20% price hike. You have seen a double-digit, or rather high double-digit, 15 to 70% deco paint volume growth for quarter after quarter in the last 2 years, despite all the challenges that we have seen, pandemic, lockdowns, etc., etc. And lower-end consumer goods have actually suffered. The staples have suffered 2-3% volume growth, while higher-end discretionary goods like paints, adhesives, QSR, jewelry are still growing at a high double-digit rate. So paints, actually, if you're a long-term investor, the best thing to do at least it has worked in the last 15-20 years, is when the crude oil prices go up, you go and buy some of these good franchises in the paint sector, and it has worked. At least it has worked for the last 20 years. I don't know whether it will work ahead or not, but the opportunity is still very solid. You are seeing resumption of a real estate cycle after a decade, right? And deco paint, typically, if you go by the past equation, generally grows at 1.5 to 2x nominal GDP growth rate. The only thing which has changed in a decade in the paints is that the repainting cycle has shrunk. Earlier, the repainting cycle used to be 7-8 years. Now it is 4 to 5 years.
Which is positive.
So that is also aiding the volume growth. And of course, some of these new houses getting built under various government schemes They are also using deco paints, though at the lower end, but it's still a volume growth for that sector. So I'm not too perturbed in certain sectors because of raw material costs, especially where there are leaders and who have demonstrated over cycle after cycle that they can exercise that pricing power.
Gautam, one more question, and again, you may not have a ready answer, but I'm still asking this to you. Where do you believe there will be the sharpest divergence in commentary between Q3 and Q4 because of what has happened in the last 15-20 days to the commodity complex?
Okay, so there are 2 or 3 sectors where the commentary is going to be very, very weak, and there are no prices for guessing it. Auto is going to be the first sector where the commentary has been weak for last 12 quarters, and it can continue to be weak for another 2 or 3 quarters. Okay. You've seen yesterday the numbers for the February month. Since then, things have worsened, right? And after the elections are over next week, you will see a fuel price hike, right? The semiconductor situation has not changed at all. What is more important structurally, and I think Bajaj Auto has commented on this 2 months in a row now. They are the only company in two-wheeler space which has come out in the open and said that there is a structural weakness in the two-wheeler demand, right? The consumer at the bottom of the pyramid in the rural is facing a stress at his income level, his or her. And the government is very clear that they are not pump priming the economy. They are actually following a prudent path of capex. But in the short term, it can have the impact on the consumption, and which is what is getting reflected in commentaries after commentaries. You saw Hindustan Lever, you saw, basically auto companies. You've seen some of the other staple companies as well coming in and saying that the volume growth is very weak. Nielsen came out with the data for October to December quarter yesterday at the industry level, which has shown a volume decline in the rural markets. So clearly, there are 2 different segments which are there in the B2C basket. One, high-end luxury goods, or not luxury rather, but discretionary, urban facing, they're doing well. Second, lower-end, bottom of pyramid, rural facing, they're facing trouble. Second sector, where you will see commentary changing again, is consumer staple. Margins are going to get impacted again. And given the weak demand, you might see impact on profit margins again. Third is cement. I just spoke about it. We've already cut the estimates by about 18% and 10% for 23 and 24. The fourth sector is consumer durables, where the seasonality is always important. And last 2 years, 2020, 2021, the summer got impacted because of the lockdown, first wave and second wave. They are hoping for a better season this time, but let us see, because the margins are going to get crushed once again. They have not taken sufficient price hikes, right? And then, of course, on the other hand, you will see commentaries maybe slightly positive is metals and energy because of the underlying commodity basket. And analysts will go and mark to market those prices in their Excel sheet, and you might see upgrades happening there. What is going to remain unimpacted and positive is financials and IT, because they've done very well. The commentaries have been solid. Demand visibility is extremely strong. In case of financials, you've seen asset quality very, very strong after a long time, both PSU and private. So those are the 2 sectors, incidentally, which have the highest overweight in our model portfolio, 300 basis points each for both IT and financials.
Awesome. Gautam, do you have 5 more minutes? In which case, I'll talk about the overweight. Okay, great. So I was reading a note from Ruchir Sharma, now with Rockefeller, who, I'm not quoting him, but he said that if the last decade data was the new oil, then in the current decade or the new upcoming future, oil will be the new data, so to say, right? He's very gung-ho on energy. My question to you is, it all seems set for energy companies, upstream in particular, to report strong earnings. It's already showing in the way the prices are going. Are you constructive, or is there a word of caution somewhere? Because the one thing that I did see, Gautam, is that somehow our upstream energy companies are not able to crank up production in the way that market typically anticipates them to, and that cost structures are very high compared to the delta in production that comes about.
Yeah, so production has been weakish for the last many years now, upstream specifically. The way to think of this company is, see, narratives change very fast here. Till about 3-4 months back, people were discussing about green, and ESG is a very well-entrenched framework now. So honestly, I don't know where these things will settle. 6 months later, when the war is over, dust is settled, people are back to green, no emission, those kind of things. maybe the oil prices will be much lower, right? And as far as investment is concerned, specifically for these sectors, you have to be very nimble-footed, because these are not structural compounding stories.
Yeah.
Here the price is basically a reflection of the underlying commodity prices. Right? ONGC 2 years back was 60 rupees, and nobody used to talk about it. Today ONGC is 165, and we can't get enough of it, because quarter after quarter you are seeing a 15-20% earnings upgrade thanks to the oil price. So see, from a practical point of view, as far as investor is concerned, is to keep one eye on the underlying commodity prices, and do not think of some of these ideas as structural compounding stories which are going to make you money year after year.
Yeah, but the gas pricing story seems real. Even if crude were to be volatile, gas prices certainly seem to be staying buoyant.
Yeah. In fact, the April, if you heard the commentaries of IGL, Gujarat Gas, and MGL, all of them said that in April, when the revision is due, the prices are going to go up by $3 to $4, dollar per MMBTU, and that is going to have its own set of consequences for consumers and users. The problem, however, Niraj, is when it comes to constructing portfolios, how much weight you want to allocate, because allocation is important. You can talk about individual ideas in a portfolio, but what allocation do you provide to some of these companies is always going to be tricky. Today, it's very easy to talk about these companies in a very constructive way, because the prices are rallying every alternate day and situation is very uncertain. I'm saying just 3 months later, 6 months later, when things are much more calm, how do you look at it? Structurally, the EV thing is becoming very well entrenched. We all know that, and that will extract its own price in terms of the long-term direction of this pricing. What we are also seeing in oil prices is years of underinvestment. Last 6-7 years of underinvestment is finally getting reflected in the commodity prices. So some of those imbalances are getting corrected, but how long this will continue, I think it is very, very difficult to answer that. As far as we are concerned, in our portfolio, we have Reliance, which is, by the way, now a combination of 3 different businesses. And if somebody is looking at a short-term trade or benefit from this underlying commodity price, then of course ONGC, GAIL, some of these obvious names are there. But I'm not sure how long this can sustain.
Yeah, but for now the going seems to be good. But Gautam, thanks for that candor. One final question, and that is on metals.
Yeah,
you are sounding constructive on the earnings. Just today, I think the European HRC prices have been revised higher, if I'm not wrong, by the Indian mills as well. Are both fundamentals and earnings growth in place for an investor to make wealth by investing in these, do you reckon? Can you talk about some numbers about how could the earnings change for the metal pack, both ferrous and non-ferrous?
So, as I was explaining in the beginning, we have seen a 10x increase in profitability from the bottom in the last 2 years. Even this quarter, we have seen a 45 to 46% growth in metal profits. We were expecting 60, so slightly lower, but still on an absolute basis, the numbers are very strong. What is important, Niraj, in some of these companies is the last 2 years, the cash flows have been extremely strong, right? And the capex has not been as buoyant. So the companies have gone ahead and deleveraged their balance sheet substantially. Whether you look at Tata Steel or a Hindalco or a JSPL or a SEL, right? So if you look at the construct of the market cap of some of these companies and account for the debt reduction, you will see that in the enterprise value, when you account for the debt reduction which has already happened, there has not been any meaningful re-rating which these companies have seen. So, in an indirect way, I'm saying that valuations have not gone out of the whack despite prices having rallied 3-4 times for some of these names. SEL was 20-25 rupees. I think it is now at 100 rupees. It's down from 150. Same for Tata Steel, from 300 to 1200. It's come up from 1500. But the profits have also gone up. And in the current environment, it is quite natural that you will see one further leg up in their earnings estimates for FY23 and 24. And more importantly, this will keep providing them the fodder for going ahead and deleveraging the balance sheet even more. Except Hindalco, I don't think any other companies, a company has announced any big capex plan in the last 3 or 4 months, right? And therefore, we still have a slightly overweight position on metals. We have Hindalco and SEL in our model portfolio. And I think that the underlying buoyancy in the commodity prices will keep the earnings elevated. And the deleveraging can continue to happen and the valuations are still in your favor. So it makes sense to stay invested in some of these metal names. Typically, when you see too much of capex announcement and price momentum slackening a bit, which we saw between September to December, that is a time you want to reassess your allocation to metals. As of now, things look good. But then, as it is the case in every commodity sector, you have to keep reassessing your position every 3 months and mark to market for the commodity prices, because these are not structural compounding stories. These are a play on underlying commodity prices, and you have to be cognizant of that all the time.
Got it. Gautam, I can go on, but I think we've done a long time already. So thank you for spending the time and talking to us. It was lovely understanding the nuts and bolts behind a lot of themes. I couldn't talk too much about the report as well, but I think in the story that we write for this interaction, we'll give a brief snapshot of the ideas that you guys are saying are worth considering in the corrective phase. But thank you so much for talking to us today.
Thanks, Niraj. Always a pleasure.
Yeah, the pleasure was ours. Viewers, thanks for tuning in.